Professional. Hi everyone. So I want to do a quick video. Some folks have been bamboozled by the whole cash flow statement thing, and so I have enlisted the aid of Stacy. Say hi, Stacy. Hi, Stacy. I've enlisted the aid of Stacy to do a quick video for me. So what I'm going to do is I'm going to walk through the cash flow statement that's in the textbook. I think it's Procter & Gamble. We've got our balance sheet, we've got our income statement. I'm going to assume that you're at a place where you've got your balance sheet and your income statement set up. Doing the cash flow statement is actually probably the easiest part of the process, because at that point, all we're doing is plugging numbers in, so long as you know how to plug the numbers in, okay? So what I'm gonna do is I'm gonna start with the Procter & Gamble balance sheet and income statement that are already forecasted in the books, and then I'm gonna show how they got the cash flow statement put together and try to make it a little bit less complicated and a little clearer, so that when you apply this to your own companies, it makes a little bit more sense, okay? So first of all, we know that our cash flow statement is three things, right? We've got our operating, and I think we need all that space. We've got our investing, and then we've got our financing. Now, one of the things we need to unnecessary zoom. One of the things that we need to remember is that the cash flow statement is what reconciles the balance sheet and the income statement. The income statement is recognizing everything on an accrual basis, and to the extent that something happens on the income statement that's not cash, it gets parked on the balance sheet. For instance, if we have a sale on credit, the journal entry is this: debit accounts receivable, credit sales. So we have here on the income statement net income going up. There's no cash flow. And so what do? Our rule says that when accounts receivable goes up, that's an adjustment down from net income to cash flow from operations. Accounts receivable going up means that we booked a sale and we didn't get cash, okay? And Stacy's nodding her head, so presumably this is making sense. So the way to approach the cash flow statement is as simple as starting with your balance sheet and then going down the list on the balance sheet and checking off every single change that you see, and making sure that we explain every change on the balance sheet somewhere in the cash flow statement, okay? And that's the way to approach it. So we start with the operating section. We know our operating section starts with net income, and for our purposes, let's go ahead and use consolidated net income. Let's not muddy the waters. Some of you folks have got non-controlling interests, some of you don't. Let's not muddy the waters with non-controlling interest stuff. We're just going to use consolidated net income and call it good. And so we're total net income. So P&G's total net income was $11,903, and our goal is to go from net income down to cash flow from operations by finding all of the things that are different between that net income number and the cash that comes in and goes out. The first thing that we always think of is depreciation. Depreciation expense is this: debit depreciation expense, credit accumulated depreciation. Here we see net income going down, but it's not cash, right? So we need to make an adjustment to go from net income to cash. So we're always going to add back our depreciation and our amortization. Now this number you should already have. If you didn't actually forecast it as part of your income statement balance sheet, then we can back into it, okay? Because we know that our, let's see, I think I actually have these, do I have these numbers down? No, I don't actually have these numbers written down. But what we know is that we have a fixed asset beginning number. So this is, we'll call it 16. And we just forecasted 17, right? Now, part of what we forecasted was capital expenditures. And so to the extent that beginning balance plus CapEx is not equal to ending balance, our forecast, which it shouldn't, that's depreciation, right? If we look at this in terms of a net fixed asset, our beginning net fixed assets plus what we bought minus what we depreciated should give us our ending. Let's not worry about forecasting sales of fixed assets, things along those lines. Again, that's muddying the waters in a way that we don't need, okay? So ideally, you actually forecasted out what your depreciation expense is, your amortization expense is. If not, that's okay. We can plug into it based upon what we know about beginning balance, CapEx, and our ending forecast. Okay, so looking at the P&G one, and make sure you've got the P&G balance sheet and income statement handy, what we can see is that the book forecasts our fixed assets to go up by CapEx and down by depreciation, and the depreciation expense is the $29.75. And then we have our intangible assets, and our intangible assets, unless we're buying a company or buying another patent or something, it's not going to go up. It'll only go down by the amount of amortization, and the amortization is $355. So in total, $3150 is our total depreciation and amortization expense, because we know that it's built into our balance sheet. It must be there. So we're going to add our $3150 of depreciation and amortization expense back in. We're always adding depreciation expense back in. Had you forecasted gains or losses on disposal of assets, and hopefully you didn't do any forecasting of asset disposals, then we're done. We don't have to worry about anything else in terms of that, and we can go straight to our operating assets and liabilities. Our accounts receivable, oh hey, come on in, that's fine. Our accounts receivable, our inventory, and so on. And that is a very simple decision rule. If a current asset goes down, we add it. If a current asset goes up, we subtract it, and vice versa. And we're going to use some long-term assets and liabilities as well. So our accounts receivable went down. It went down by $101, so we plug it in there. Again, you know what your beginning, what your ending, or what last year's accounts receivable is. We know what you forecasted accounts receivable to be. Take that difference and plug it in. The thinking is done. All of the thinking is done. Now we're just plugging in numbers. And we're going to go straight down the line. Our inventory went down by $75, so we're going to add that in. Our deferred income taxes on the current side went down. We're going to add that in. Our prepaids went up. When a current asset goes up, we're going to subtract it, and that's going to be a subtraction of 81. We then turn to our liabilities. Our accounts payable went up. When a liability goes up, we're going to add it. That'll be 108. Our accrued liabilities went up. We're going to add in 142. And then there are a couple of long-term items that are operating simply because we know they're not financing, and we know that they're not investing. So we're going to take those long-term guys and we're going to stick them in here as well. Though typically when we talk about cash flows, it's always current liabilities and so on. So we're going to take our long-term deferred income taxes. Those are going to go up. And so we're going to add that. And then our other liabilities, our other long-term liabilities, are going up, and we're going to put that in here for 185. And when we add all this stuff up together, well, crap, I don't have that number. Whatever that number is, well, you've got the cash flow statement. It matches the thing in the textbook. Sorry about that. Whatever that number is. Okay. And there's, I know, awesome. There's our cash flow from operations, okay? And we've checked off most of the items on the balance sheet. We really don't have that much left to do. On the asset side, the only thing we haven't yet explained is the change in our fixed assets. And so we're going to do that here in our investing activities. We have a forecasted out cap expenditure. That's what we did. Debit fixed assets, credit cash. And so we're going to have our CapEx of $38.44. That's going to be a negative cash flow used in investing activities, and that's it. If ideally you didn't forecast any changes in goodwill, good heavens don't. You didn't forecast any growth in your other intangible assets, please don't. And so the only thing from an investing aspect that we're doing is this, with one exception. I guess the one exception would be if we had to plug to marketable securities to make the balance sheet work, we would put our marketable securities here as well, right? Because I think the book has us either plug to short-term debt or plug to marketable securities. Is that correct, Stacy?
Yes.
Yes, that is correct. So if we had to plug to make our marketable securities go up, we would include that here as well. The point being, of course, that we have explained everything now on the asset side. The only account on your asset side that doesn't have a check mark next to it should be the cash account. And that's the whole point of this. So we're not going to solve that until the end. Yeah. So now what have we got left on the balance sheet? We've got our debt and we've got our equity. And that's what's in our financing, right? That's our financing is where did we get our capital, and our sources of capital are either equity or our long-term debt. And so what you can do, the book actually broke it out into how much are we paying, how much are we collecting. Honestly, I don't think that's necessary, unless you've already done it, of course. We know how much total debt we've got. Our total debt, when we take into account our long-term debt, our short-term debt, and our current maturities of long-term debt, our beginning balance is 4506 when we add all three of those together. Our ending balance, our forecasted balance, when we take into account what we've paid off and so on, and there's that plug for short-term debt, I believe we get 5223, which means that in total, so this is beginning, this is ending, which means in total we must have borrowed an additional $717 million or $1,000 million. And that's it. That's it. There's no other ambiguity. If our debt went up, we must have borrowed. And if our debt in total went up, we borrowed $717 million. Don't overcomplicate things. Look at the change in your debt. That's what we either borrowed or that's what we paid. End of story. So we borrowed a total or a net of $717. The book has us forecasting out treasury stock repurchase. Maybe you put that into your forecast, maybe you didn't. What we would see is the treasury stock account on the balance sheet changing. If the treasury stock account on the balance sheet changes, then we have to adjust for it. In this case, they assumed that we bought back some treasury stock. And so we have treasury stock repurchase of $6,000. And then we would have forecasted out our dividends. We had to have forecasted out our dividends because that's how we got our ending retained earnings balance, right? Here's our retained earnings. We had our beginning plus our forecasted net income minus our forecasted dividends gives us our forecasted ending balance. So we already know what our dividends were. So put those in here as well. These would be our dividend payments. And that is, in this case, $66.28, giving us a net cash flow from financing activities of $11,911. And at this point, then we're done, right? We've got our operating cash flow, which is a smiley face. We've got our investing cash flow. This was the only thing we had. This is our financing cash flow. And so our net change in cash is $119. This minus this minus this was a net increase of $119. We had our beginning cash, and our beginning cash was $59.47. That was given to us. And if we've done everything correctly, then this is going to equal our ending forecasted cash flow, in this case of $6,066. Look back at your balance sheet. Look back at the balance sheet here. There should be a check mark next to every single account. We had our treasury stock, we've got our retained earnings between these two, we've got our debts here, we've got all of our operating items here, and we've got our fixed assets here. We've explained every change on the balance sheet, and if we've done that, this is going to balance. Okay, so that's the idea. I think that some people are trying to get too deep into actually trying to predict out, oh my gosh, what is this? What are we going to do here, and what are we going to do here? And we've already done that. All of that stuff was done when you predicted out the income statement, when you predicted out the balance sheet. When we get to the cash flow statement, it's simply an exercise in math making sure you put things in the right places, but all the data is already there. There's no additional thinking that you need to do. Okie doke. Hopefully this is helpful. I hope that this got to folks in time and can save some headache and save some angst. And that's it. Thank you very much to Stacy. Say bye, Stacy.
Bye.
Bye, Stacy. And that's it. Bye, kids.